Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss why you would sell a put option and how it can be used as an income-based investment. So why would you actually sell a put option? First thing that I'd like to mention is that in a previous video, we talked about what is a put option. We covered when you would buy a put option in the previous video. If you're not familiar with what a put is, we'd recommend that you take a look at that video before watching this one. Today, we're going to go over why you would sell a put option. Now, the first thing that I want to say is that there's no inherent risk or reward or benefit or drawback to either buying or selling options. There's advantages and disadvantages to both of them. Plenty of money has been made and plenty of money has been lost by both option buyers and option sellers, at least in the near 20 years that I've been in this business. So what I want to go through today is the reason why you would consider selling a put option as a potential income strategy. Now, the first thing that I want to do is go over the risk of actually doing this. No matter what trade or investment you do, there's benefits and there's drawbacks to everything. Let's go over the drawbacks first today. Let's take a look at this risk-reward graph right there up on the screen. And you can see on here that the stock is trading, and this is XYZ stock, it's trading at $21 per share. You can see the risk reward for the stock. It can go higher or it can go lower, like we always have discussed in any of our videos. Your risk reward on this, if you were to buy the stock, would be $21, or in an increment of 100 shares, $2,100. What we're doing in this instance is we're not buying the stock. We are selling the 20 put, and we're getting a $20 credit for it. So we're risking $2,000 and we're making $20 on this. Now, you might say, well, that doesn't seem like a very good risk reward, $20 for $2,000. Why would I consider doing that? We'll talk about that in a moment. But what we need to have an understanding of is the fact that if the stock were to go to zero, you would be out the $2,000 minus the $20 credit that you received. In order to make your full profit on this trade, the stock has to expire above $20 per share. If that's the case, then you know that the option will expire worthless and your obligation has been fulfilled. That's how you would make money on this trade. But let's dig a little deeper. Why would you actually go into a trade to where you're risking $2,000 in order to make $20? Well, first off, let's say this is a 1-month trade. You can do option sales anywhere from 1 day to a couple years. Let's just use this as a 1-month trade. $20 divided by $2,000, you're getting close to a 1% rate of return for 1 month. Now, if you annualize that, that can come out to a pretty decent deal. You might say, okay, well, I like the idea that I can get over 10% annually if I do this every month, but is this a high risk trade or a low risk trade, or how would that work? Well, the way to think about this is that the stock's at $21 per share right now. That means the stock can go down $1, well, 99 cents. The stock can go down 99 cents and still be out of the money, meaning that if it never touches $20 during this 1-month time frame, then this option is going to expire worthless, even if the stock goes down over 4%. Makes you think a little bit, doesn't it? Now, the next part of this is that when you annualize it, this comes out to a pretty decent rate of return. Now, of course, you're not going to get this premium every month, and the stock's not always going to behave every month. But what this does do is this gives you the ability to create an income-based trade for a 1-month time frame at a pretty decent rate of return. It just depends on what your risk reward is and, quite frankly, what you consider decent for your decent rate of return. Now, something that's very popular these days in the advisor world for those of us advisors that work with options is something we call a wheel trade. Let's say we like this stock. It's $21 per share, and we love it at 20. We like it at 21, but we love it at 20. We could sell a $20 put option with the intention and hope that the stock actually goes down to 20 and we get assigned. What that does is that gives us the ability to get paid to get into a stock at a price we wanted to get into it at in the first place. Now, of course, the risk of this method is that the stock could go to 20, we never get assigned, and then go right back up. But what this does do is this gives us the ability to collect some income should the stock go down and we actually get paid to get into it. Let's say it goes to like $20.50 a share after a month. The option expires worthless. We do the process again. We continue to do it until the stock comes down to the level with which we want, or it just runs away from us. If it takes 3 or 4 months for the stock to come down to the level we want to buy it, you're essentially getting paid to wait until the stock comes in to a level that you want it to actually buy it. Now, the wheel trade is one to where once you're in the stock, after it gets put to you, you're looking to sell a covered call, perhaps around the 20 level. You sell a covered call, which we talked about in a previous webinar. You then wait for the premium to expire or wait till you're called away. If you're called away, you sell the put option again the next month, and you continuously do this as an income stream. It's something that's becoming very popular in the investment world when using covered calls and short puts. Now, in reality, a lot of times we exit these trades before they expire worthless. We'll talk about that in another webinar coming forward. Also, the final thing that I want to mention on this is that as you're looking at that risk-reward graph over there, you're probably noticing that the risk-reward of the put option is identical to that of a covered call. Well, that's because it is. Synthetically speaking, selling a put option and selling a covered call are the same thing. We'll also talk about that in a future webinar as well. Now, if you enjoyed this video, please subscribe. We'd love to have more subscribers, and this is a way with which we can get our content out to more people. Also, if you are looking for a financial advisor who uses the option product and does strategies just like the one we discussed, feel free to reach out to me. You can reach out to me by following me on Twitter, as well as checking out my website, stcharleswealth.com. Thank you and have a wonderful day.